Welcome back to the Core Curriculum Show. My name is Crawford Anderson. I'm the founder of AWM Financial, a platform for personal finance education for students and young adults. And I write a weekly personal finance column for the Niner Times. I'm here with my co-host, Thomas Wong.
I'm Thomas Wong, and I play on a rec league basketball team, and I'm also a major in finance.
Heck yeah. I believe we're both juniors, right?
Yeah, we are.
Awesome. Today... Sorry, what were we saying?
What are we getting into this week?
We're getting into the S&P 500. Last week, we went over the overview of how investing works, what compounding is, what it actually means to invest in a business. And this week, we're going to take not quite a deep dive, but a medium dive into what the S&P 500 is. We briefly talked about it last week, but now we want to go into more detail.
Yeah, so S&P 500, we talked a lot about how S&P 500 on your last time.
In fact, studies show that 99% of Americans are dehydrated. Take a drink of water every time we say S&P 500 today.
So the S&P 500 is something called market cap weighted.
Absolutely,
and you refer to it in your article.
Yes.
What does that mean?
So market cap weighted means that the value of the companies in the index, which is called the market capitalization, that's how much the public, the market thinks a company is worth. So like Apple right now is about $3.5 trillion. It's a lot. With a T, by the way. That means that the bigger the company is, the more of the index it takes up. So the largest companies, Apple, Google, Microsoft, they make up 5, 6, 7% of the overall index, while the smallest companies make up just a fractional percentage of it. So 0.02%, 0.1%, a very small percentage of it.
Okay, so now as an investor, I'm a little bit scared because I say more of my money is tied up in these companies.
Yeah.
What would you say to somebody who says that?
So I would say the market cap weighting is one of the key features of the index. That helps investors significantly because the biggest companies are usually the best companies.
Yeah.
They're the ones that are making the most money for their investors, and that's why they've grown so big. And so if you look out at the history of the United States and our stock market and our economy, over the years, different companies have been the biggest in the S&P 500 index. Blockbuster used to make up a significant portion. They used to be a much bigger company, and now there is no Blockbuster. Now it's just Netflix and Disney and stuff. Another thing to look at is Sears. I don't even know if those even exist anymore.
What the heck is Sears?
But there used to be these things called malls, right?
Yeah.
But people would go and buy their clothes and buy all their necessities at Sears. They went public in 1906, and for many decades, not just years, they were one of the largest companies in the U.S. In fact, fun fact, you could actually buy a house from their catalog, which is crazy.
Yeah.
But at one point in their life, they were the biggest company. They were one of the biggest companies. And now, obviously, they are a very small company. I don't even think they exist at all, in fact.
Yeah, I know the one in my hometown got torn down.
It's a tough way to go. But that's why market cap weighting is so important, is because as companies get bigger and better, they make up a bigger portion of your index, of your portfolio. And then as companies grow smaller and less profitable and are less good companies, they slowly become less of a percentage of your portfolio.
So it's like a pulse check for the overall U.S. economy.
Yeah.
What's in right now, what's hot,
Yeah. So while the S&P 500 and the U.S. economy are not one-to-one comparisons, typically speaking, they both reflect each other in one way. The stock market is forward-looking, meaning as an investor, I'm betting on the future. I'm investing in the future. Betting is the wrong word to use. We talked about last week. But I'm investing in the future. And so that's a good way to get an idea of kind of where the economy might be going. And it's also a reflective look at the economy because you can see what companies are the biggest portion of the United States economy. So right now, that is like semiconductors and chip companies like NVIDIA or massive retail companies like Amazon or Walmart that are the biggest part of the index. But let's talk about some of the other rules that make up the S&P 500 index. So the index is maintained by a company called Standard & Poor's. So they create the index, and they have a team that generates all the numbers behind it and makes sure that the rules stay consistent and the same over many years. Every quarter, that's every 3 months. So every quarter, they readjust it so that it keeps following the rules that they have for it. And to qualify, companies have to be U.S.-based. So both legally and their headquarters.
Good.
Yeah, good. Yeah. And they have to be profitable for the last 4 quarters, so the past full year. So companies can't be just losing money all the time.
Yeah.
That's great for me because as an investor, I don't want to invest in companies that lose me money. They also have a minimum market cap requirement of $20 billion, which just means that really small companies, maybe we can go back to your lemonade stand from last week, they wouldn't be eligible to be a part of the index. So it mostly just tracks large U.S. companies.
Yeah, my lemonade stand won't be part of it yet.
Yes, you haven't. You're building an empire, Thomas. Yeah. You're building an empire. But those are basically the rules of the index. There's some other smaller rules like liquidity requirements, which just means that a certain amount of the company's shares of the 100% that they've issued need to be tradable for the public. So basically, you can't just have like you issue one share of your lemonade stand and have that be on the stock market. It has to be a large part of the company that's available for purchase. But that's basically the rules that protects investors and even benefits us so that we can make more of a return on our money.
And I'm not 100% about this, but I would assume that at least the accounting regulations are a little bit cleaner for this. You know what I mean?
Yes. So if you go look on the article, or even you go directly to Standard & Poor's website, they have all the nitty-gritty details, exceptions, and all that. But basically, the big things to remember is that it's market cap weighted, so bigger companies make up a bigger proportion of the index. It gets rebalanced every quarter, and then there's a requirement for how large a company must be to be a part of the index, and it must be U.S.-based and profitable.
Yeah, that's pretty good from Standard & Poor's. And something I have in my notes that I briefly wanted to cover was ETFs and mutual funds.
That's a great question. So when we talk about the index, you can't actually invest in the index, right? That's just a number made up by Standard & Poor's to track these 500 companies. And right now it's trading it's at about $6,950 per share, even though you can't buy shares in it. If you do want to buy shares in it, you can buy what's called a mutual fund or an ETF, which stands for Exchange Traded Fund. We'll go over what both of those mean in a second. But basically, by buying one of those two things, I can buy one stock, kind of. It seems like a stock. It looks like a stock, also known as a ticker symbol. I can buy just one of those. And then a investment company will, on my behalf, go and buy all 500 companies that are part of the index. And they'll go buy it at the appropriate weightings. So they'll go buy 7% of the ETF into Apple and 6% into Microsoft, and that way I will be a partial owner in all 500 of those companies and track the index.
Yeah, so I know my parents have mentioned mutual funds before.
Yeah.
What am I listening to?
So there's some pretty specific details on the differences between the two, but basically a mutual fund is a product issued by an investment company that takes my money and goes and buys the products that they're offering on my behalf. It's more of an antiquated version of the ETF. Unlike an ETF, it only trades one time per day. So at the end of the day, the price of the fund is recalculated, and I'll be able to see whether I'm up on paper or if I've lost money on paper. Excuse me. And yeah, there's some other key features and benefits to them, but generally speaking, they are more clunky. So there's less clarity. They're less tax efficient, and then there's also higher fees typically associated with mutual funds, meaning that I'm having to pay money to an investment manager to be able to take my money and invest on my behalf. Typically speaking, ETFs are more passively managed, which means they have a lower cost to run, and they're also easier for me to purchase because I can buy them throughout the trading day.
Yeah, so it's kind of old versus new.
Yeah, ETFs are a bit of a newer concept. They've been around. The first one that tracks the S&P 500, actually, the ticker symbol is SPY. So if you ever hear us refer to the S&P 500 as SPY, that's why. I just made a rhyme. I'm calling Dr. Seuss. But that's the first one. I believe that came out in 1996. So they're about 30 years old. Mutual funds have been around for much longer than that.
Yeah, and I like the point, just to go back. The S&P 500, you're investing through something like a mutual fund or ETF.
Yeah, and we're going to use ETFs as our example because I personally have an ETF that tracks the S&P 500, and most other people who are our age should be focusing on buying an ETF just because they're simpler and more efficient. Yeah,
so you're getting a broad taste of the market.
Yeah. So when I go and buy $1 of, and I'm going to use the ETF that I own, it's called SPYM. But they're all the same. They all track the same index. They all own the same percentages of companies. When I go and invest, and I can invest as little as $1 into it, it goes and buys the 500 different companies on my behalf. Then I own really small slivers of all those companies. And if I'm just investing $1, then it's a really small slice.
So that $1 gets split into 500 different pieces, something like that.
Yeah, exactly.
Okay, so tell us a little bit more about the money makers in the S&P 500.
Yeah, so right now, there's something called the Magnificent Seven.
Yeah.
If we go back a few years, there used to be something called FANG, so FAANG, I think. And so over the years, different companies have made up a bigger proportion of the index. Right now, the biggest 7 make up about 35%, while the other 493 companies make up the other 65%.
Yeah.
Right? Am I doing my math right?
So yeah, the math major.
Yes. Let's ask the math major.
So about one third, give or take, 1/3 is invested in these market drivers.
Yes.
Kind of.
So these are the companies that you've heard of. There's when you're talking about 500 companies, most of us probably haven't heard of a lot of them, in fact. But the biggest 7 are the most well-known companies in the world. So we're talking about our Apple, our Microsoft, our Amazon, our Meta, which owns Facebook, Instagram, and WhatsApp. Our Google owns YouTube, and technically it's owned by its parent company called Alphabet.
Yeah.
But that's just a legal filing. Basically, it's Google, and they own YouTube and Waymo, the self-driving car company, and all these other companies that people have probably heard of. And then you have your Tesla and your NVIDIA, which is actually the largest company in the world right now. And they're doing the semiconductor chips that power all of these other companies.
Yeah, and and a lot of professionals out there, if you listen to some broadcasts, they'll mention the Mag 7. But you and me, at least when we talk, we like mentioning the 5 who drive profit.
Right, the 5 biggest companies that are consumer focused.
Yep.
So that's your Microsoft, your Facebook and Instagram through Meta, your Google, your Apple, and the one that I'm forgetting, Amazon. And Amazon. Everybody loves Amazon. It's taking all of our money, right? And those companies are the products and services that we use in our daily lives. So if you just think about an average typical day for you, you're probably Googling a couple times a day. You're almost certainly going on Instagram or WhatsApp or even Facebook. You're probably buying something off of Amazon. Maybe you're listening to Amazon Music or a podcast on Amazon Music, or you're watching your favorite new show on Prime Video.
Yeah.
You're listening to a book on Audible. I mean, there's so many products and services offered by all these different companies. YouTube. I mean, as a college student, I think YouTube is probably our most used app.
For sure, 100%.
Through, watching clips, shorts, reels on Instagram.
YouTube shorts,
yeah.
Dude.
Yeah, it's killing me, man. The screen time's killing me. But all of these companies are providing us products and services that we use on a daily basis, and they are massive, massive companies. The 3 of them combined, or the 5 of them combined, are worth, I think, over $10 trillion.
That's crazy.
Yeah, it's wild.
And I think it's important to clarify that although these are the biggest companies right now, again, it's like a pulse check.
Yes.
These companies interchange, they move. Who knows, in the next 10 years while you have your money in the S&P 500, oftentimes these stuff kind of change based on the flavor of the market and the economy.
Yeah, absolutely. So if you look at 10 years ago, I don't know all the specifics on the top of my head, but there was a lot, the technology companies were smaller.
Yeah.
If you look at the period of 2000 to 2010, there's more energy companies, more retail companies, and so now it's mostly AI companies and technology companies. We don't know if that's going to be the future. We think it might be, probably. Technology is very important, and AI seems to be what's coming next, but that's kind of the beauty of the index, is that it's self-correcting. So over time, whatever is the biggest and most profitable company will be the biggest part of your portfolio. And who doesn't want that, right?
Yeah, and again, even if somehow all the experts get it wrong,
yep.
That have invested in have invested in the Mag 7, and all those bets, it's still only 1/3 in their other profit drivers, because there are
absolutely
hundreds of other companies,
and they're all profitable.
Exactly, they're all profitable.
Yep.
And they're all managed.
Yep. Yep. And that's one thing I love to think about, is that on any given day, not just thousands, I mean literally millions of people around the world are working for me to go and invest in new products and services, sell those products and services on my behalf to make me a profit. Yeah. And while I may not be a complete owner in Apple or Walmart or Facebook, I am a partial owner, and that still makes me an owner in those companies.
Yeah, that same iPhone that you own, you have a piece of that iPhone.
Yep.
And we also benefit off of the expertise of the people working in the factories or even the CEO.
Yeah, so like Tim Cook, the CEO of Apple, he works for me. I vote for him to be CEO. In fact, he is my worker in some sense.
No, obviously, I like that.
It gets more complicated on the legal side, but in actuality, that is the case, is that I am an owner in the company. I get to vote for the board of directors who represents me as the shareholder, and then Tim Apple gets appointed by that same board and then goes and appoints all of his coworkers and the chief financial officer and all the employees of Apple. They have hundreds of thousands, and they're all working to build the next phone or the next TV show on Apple TV Plus or the next whatever service they're developing, which is going to go make them profit for me.
Yeah, I think that's a great way to put it, you know. It's 500 companies, and you're getting a taste of all of the companies and all of the professionals from the experience, you know?
Yeah.
And just like last week, how we mentioned that the average return is 10% and it compounds over time.
Yep, and that's the average return over the last over 100 years.
Yeah, so which is a significant sample size.
Historical data, absolutely.
Yeah, and that, you know, usually the market, at least, I'm a statistician, or stats person, so we like saying the market, like, redirects back to its norm. And if its norm is 10%, you know, that's something trustable over a 100-year period.
Yeah, so some years, like last year, the S&P 500 gained 17%.
Yeah.
The year before that and the year before that were both above 10%. Over time, it will revert back to 10% on average. And while I can't tell you that this year or next year is going to be a year where the S&P 500 loses money because nobody can predict the future, I can tell you that over time, it will average back down to 10%.
Yeah, I think, great way of putting it. You know?
Yeah.
So we have the S&P 500 down, you know? I think we've taken a good jump into it.
Yeah. We've got a little bit, we took a medium dive, not quite a deep
medium
dive.
Right? Yeah, a deep dive would, I don't want to see what a deep dive has to look like.
Take a college course on it.
Yeah. But if we look forward to the next show, what are we looking forward to?
So next time, we're going to go over some of the ways that you actually do all the things that we've talked about. We've talked about investing. We've talked about compounding. We've talked about, the S&P 500. But we didn't actually talk about how to invest, not just, psychologically or generally, but like the nitty gritty of how do I actually go and buy a stock? Because if you think about a bank account, we all have a bank account or of some form, whether that's on PayPal or Venmo or at Bank of America. But how do you actually invest in stocks? And that's called a brokerage account. We're going to go into more of that next time.
Yeah, it's not like you just look up, website, S&P 500, and then you're able to place a trade down immediately.
Yeah, no, it's a little bit more complicated than that. Yeah, there's a lot of laws, a lot of regulations behind it, but it's mostly to protect us as the investor.
Yeah, they're all designed to protect us. It's not consumer anti-friendly. I don't know what the word would be, but
investor friendly.
It is very investor friendly.
Yes.
You know? Yeah. So
if you want to go read the article that is the spine for this week's episode, it's called From Cafe Lattes to Dining Hall Buffets. We got a cute little analogy in there by yours truly. You can go ahead and find that article linked in the show notes, which will take you to the Niner Times article, or go to awmfinancial.net for more information and educational content. Yeah,
and just before we end the episode, where did you get the inspiration to write the S&P, a deeper dive into the S&P 500?
So I've always been very interested in personal finance and investing in particular, and many people have asked me, what do I invest in? And people love to try to find the right stock or pick a specific thing, and that's very hard to do. Even professionals struggle with that. In fact, most professionals do not beat the S&P 500. And most people don't have the time or the effort required to do in-depth research and analysis on companies. The best thing to do is to buy a little bit of the S&P 500 every week or every month whenever you get paid. Set it up. You can make everything automatic so that it automatically drafts from your bank account and so that it automatically invests for you, and then forget about it for 40 years and you will be a millionaire.
If you can't beat them, join them. And if you're...
Absolutely.
Joining them means I'm beating professional. I'm going to do that every single time,
Yes, it's incredible to think that we both can beat the professionals, and you too can beat professional investors just by buying one simple index and holding it for a long time.
All right, sounds good.
Absolutely. See you next time.
Yeah.